Hey guys, check out this video that I made with John Ewing from Ewing Morris. He is a CIO of this investment fund, which manages around $600 million worth of assets. You heard that right, $600 million. So obviously someone really good to learn from. We had some great conversations about value investing, how to pick stocks. We even had a couple conversations around how to call up CEOs and get some information about their companies. I think there's some very interesting tidbits here that we can learn from John Ewing. So check it out and let me know what you think. All right, so we're here today with John Ewing from Ewing Morris, the Chief Investment Officer.
That's right.
Do you want to tell us a little bit about yourself and your company?
Sure. Ewing Morris started in 2011 by myself and my partner Darcy Morris. Should I look you or there? What do you think would best?
It's either way is fine.
Okay. Ewing Morris started by myself and my partner Darcy Morris in 2011, and we manage money for successful Canadians, invest in primarily public markets and in both small mid-cap stocks and high yield bonds, and really invest what we call private equity mindset to public companies, and that means deep research, limited number of businesses, and try to understand them really well and own them for a long time, and really think like you're an owner and take that long-term approach.
Nice, awesome. So kind of like the Warren Buffett type of
approach, that's right.
I suppose.
That's right.
That makes all sense. And you guys have been around since 2011?
2011, yeah.
Right? And then just to give an idea of like the size of the firm and that sort of thing, like what AUM do you guys have?
We're a shade under 400 million, kind of split about half and half between bonds and equities. And
nice. So you guys have actually grown since I was reading an article the other day. It said 260. So you guys have grown quite a bit. Since
we've had
it's great.
Good steady growth over time. Yeah.
Nice. That's awesome. Cool. So I was also reading you guys have several funds, right? Do you want to talk about kind of each one of these funds and what they?
Sure. So the fund that we started with is called the Opportunities Fund. That was designed as a really flexible, go anywhere, do anything fund. That's I manage that fund, and it was primarily focused on small mid-cap North American stocks, but it's got the flexibility to go up market cap if that makes sense, to go international if that makes sense. We can own debt if that makes sense. So some flexibility around that core.
Okay.
The flexible fixed income fund is focused on the high yield bond market or other securities that sort of look like high yield bonds, convertible bonds, preferred shares, some things like that. And then there's the Dark Horse Fund, which came to us through an acquisition with a firm called Broadview Capital Management several years ago, and so partner Anthony Hamill runs that fund. That's a long short equity fund, little smaller cap focused than Opportunities Fund, and tends to run closer to market neutral than sort of the long bias of the Opportunities Fund.
Okay, cool. The long short fund definitely sounds very interesting. Do you want to maybe we could dig into each one of these?
Sure. I think our primary focus is, like we were saying a moment ago, like long-term perspective, owning fairly limited number of businesses that we think we know well. I think being able to short stocks is just gives you another tool in the toolkit of sometimes you find situations that look broken or impaired, and to be able to take advantage, to make money off that insight is something that's helpful, and you can also use the shorting to hedge certain risks or sort of change the tilt of the portfolio.
You guys weren't short GameStop, were you?
We have not been. We haven't been short any meme stocks. No.
So it's a very good idea. Definitely.
Yeah. No, I think single name shorting has gotten. It was never easy before. It was gotten even harder in the sort of GameStop era. That you got to be really careful that you don't accidentally step in front of a bus like that.
Yeah, definitely. Right. I forget who was Einhorn or someone like that got burned really badly by that one, right?
I think so. Yeah.
Yeah. So you guys go short like indexes or
sometimes indexes, and in the fixed income strategy we'll do like equity hedging, where you might be long a company's bond and be short the stock of the same company, and so that's a way you can often take a lot of risk out of the situation by doing that. And the sort of the analogy we use about that is, it's the same company, so sometimes you get the bond markets tend to take a more pessimistic view about things because there's no upside in bonds. You either get your money back or less, and so credit markets tend to be really focused on downside, and so sometimes they're looking at a business too pessimistically, and so that's one view. And equity markets tend to be more optimistic, and they might be more highly valued. But if you've got, so sometimes you see a company where the debt's saying one thing about the company and the equity saying another, but it's the same company, and they eventually have to converge. And so, like an example of this, back in 2016, oil prices had collapsed, and you had energy company debt, Precision Drilling, oil and gas driller was one. Bonds were trading 60 cents on the dollar, and so the debt market is saying this company might go broke.
Right.
But the company still had a $2 billion market cap. And so the equity market is saying things are okay. It's the same company, so one of them has to be wrong. And so, if you can be long, in that case, long the debt and hedge some of that with stock. And so if the company goes broke, you might lose money on the debt, but you'll make a lot of money on the short. Or if the company does well, a lot of that's already priced into the stock. So the stock might go up a little bit, but you probably don't lose much or anything on the short. But if the company doesn't go broke, the bonds are going to rally from 60 cents on the dollar back to par. And so, like in that case, the bonds were at 90 cents 6 months later. The stock price was actually down, and so you got paid by the insurance. Like I think you were taking very little risk because of the hedge, and the insurance actually paid you, and you made a lot of money on the bond. So that's another use of shorting that will do a lot.
Yeah, this sounds like a great return for.
No, that was a great one.
Yeah, that was a great one. Awesome. Nice. Well, what other cool, I guess, calls have you made recently?
Yeah, I think Canada's the best jurisdiction in the world for shareholder engagement, and activism is a more recognized word, and I don't think that describes what we do or what we mean. Where I think activism connotes a really confrontational approach that that I don't think works very well, and especially doesn't work that well in Canada. But the legal system is different here, very shareholder friendly, and if you know how to use the legal system, have relationships with other institutional investors, you can operate off the radar and really affect change. So we've had, between me and my partners, have sat on a dozen public company boards, and being involved in these situations, you can find a way to help the company create value for other shareholders, and do that doesn't sort of not correlated with what's going on in the market. So
interesting.
Partner Darcy just joined the board of this is a U.S. company, but the same concept applies, of a company called Cedar Realty, which is they own grocery anchored strip malls in a corridor from Boston to Washington D.C. And I think the market had sort of painted all retail real estate with the same brush, that Amazon's killing everything, and you got to be careful in retail real estate, but grocery anchored plazas seem a lot better insulated from e-commerce than enclosed malls, and so there were kind of babies thrown out with the bathwater, and so we're one of the larger shareholders of the company. They recently asked Darcy to join the board, and it's been a good setup so far.
Cool, nice, awesome. Yeah, it makes a lot of sense. I mean, you still need to get groceries. Doesn't matter, pandemic or whatever, right?
Absolutely, and e-commerce just doesn't work that well in grocery, because you've got with e-commerce, the grocery store's got to pay someone to pick the groceries off the shelves. They've got to pay someone to deliver the groceries to your house. They got to provide the delivery vehicle. Whereas when you go to the grocery store, you pick the items for free, you do the delivery drive for free, and you provide your own vehicle. And so there's these extra costs that go with e-commerce that you don't have in sort of the traditional, and
Right.
people are pretty price sensitive on groceries. I mean, anyone who shops at Costco drove by at least one other grocery store to get to Costco. So
Yeah,
I think that
sure.
shows you that people are price sensitive, and so
Yeah.
it's been hard to charge sort of service premium, like delivery premiums for groceries. But if you don't charge a premium, you've got all these extra costs and an already thin margin business, and
Yeah, that
and
doesn't
then the
make
math just doesn't really work.
Yeah,
So
yeah.
I don't think e-commerce is gonna be a big part of grocery.
That makes sense. I mean, even I was in New York the other day, and Amazon bought Whole Foods, which I guess is the reason why they bought us, because of margins, right? That makes a lot of sense. But then they basically they started using the grocery stores as warehouses, right? So even if e-commerce eats more into it, you're still going to need a spot to have the groceries somewhere.
No, I think that's
right?
it's you'll probably have more of the click and collect, where you sort of shop online, but you still
Right.
go somewhere to pick up your groceries, and grocery stores are already located to be close to where people live. They've got parking. They're already sort of great warehouses with refrigeration and all these things for if they didn't exist, and groceries were going to be online, you would need to build something like a grocery store in the places they already exist. So
it's basically a warehouse for groceries.
I think the real estate should hold its value.
Yeah, it makes a lot of sense. How's that investment going so far?
It's been great. I mean, we got there was you had to sell off with COVID, and then it's a relatively small company, and it got kicked out of a couple of real estate indexes, and that created some forced selling, and that really set up a great entry point, and the stock price has done pretty well since we got involved.
Yeah. I feel like the entire market is just it's crazy. I know we owned actually Tesla at the beginning,
Okay.
right after the
smarter than
pandemic.
us.
It was like, well, I mean, I don't know. That was I wanted to own Tesla for a while. And it's just like, there's a great opportunity. It seems like it's a fire sale. Right?
Yeah.
But it was good. This I feel like the last year's been quite good for in terms of investing as a whole, unless you're short the market or something, right? Cool. So that's some good investment. Do you guys ever do private stuff, or is it's all public?
Overwhelmingly public. Sometimes there's opportunities to sort of partner with our clients on a one-off basis on a private situation that might make sense for some subset of clients. But I mean the beauty of public markets is that you get a price every day, and so
Right.
you can in private deals usually the seller pick the timing and the price, and you can sort of take it or leave it type of thing. But in public markets, you get chances to buy fractions of companies at prices that no one would ever sell you the whole business.
Right.
At that price. The first business, the first stock Darcy ever looked at was Loblaw, and this was probably in the 2004, 2005. Stock was, I think, $70 a share, something like that, and they were just embarking on this general merchandise strategy, and I remember Darcy telling me, going on the weekends, walking the stores, talking to store managers. It didn't seem like the strategy was resonating with people, and so he thought it was a pass then. But at the time, they owned all their own real estate, and people thought that was worth $25 or $30 a share. And then in the financial crisis, the stock got down to $25 a share, and so now it was a lot more interesting. And there's if Jerry Schwartz at Onyx had gone to Galen Weston and said, I want to buy the whole company at 25, it would have been a pretty short conversation. It's not for sale at all, and it's definitely not for sale at that price, but there's nothing Weston can do to stop you or I from buying 1,000 shares at $25 a share.
Yeah.
And so that ability to take advantage of prices is something that you get in public markets that you don't get in privates. And I think that's just a huge advantage to if you know what something's worth, then that price volatility equals opportunity.
Yeah, it could be helpful. Yeah, like these crashes, like when things like this happen, you get things that are on fire sale that probably really shouldn't be, right?
That's right. Yeah, and it's like if you if you're confident you know what it's worth, then you can take advantage of that. If you don't really know what it's worth, then it adds fear and like it scares you even more, sort of thing.
Right.
And so
it's what was it, the something of crowds, like that what that saying goes, basically like, you know, when everyone's running at the exits, you know, you feel like you should too, right? Even though it's probably not a good idea. Right?
No, absolutely. Absolutely.
Cool. So it sounds like you guys do a lot of due diligence in your companies.
Yeah.
Right. So, so you know, you go in. So I guess you sit on the board of like some of these companies.
Sometimes we sit on the board. Yeah, it's not the default, but sometimes.
So how do you do that kind of research, right? Like, how do you go about?
Yeah, I mean, like you start with the financial statements. Interviewing management is a big part of the process.
Just call them up and.
Yeah, and like, you know, it's surprising. You know, we used to work at a bigger firm, and you never know how much of your sort of reputation is the name on the business card versus the logo on the business card, and I think we weren't sure. You don't find out until the name and the logo is the same thing, but we were really surprised with the access to management we got, even right when we started. And I mean, I remember when I first started learning about investing, it was still just near the end of university, and I submitted questions through the investor relations forum on websites, and I got calls back from CEOs just as a student. And I think the thing I really learned is that like people love talking about themselves, and people love talking about their business. And so if you can demonstrate that you've done some homework and that you've got some interesting questions to ask, then people will make time for you. Like the CEOs, I don't think like they don't have a lot of patience for the, you know, what's your tax rate going to be next quarter type of questions. But if you get into strategy and capital allocation, then they have a lot of fun talking about it, and you can get surprising access to management teams. Sometimes you've got to go up the ladder where you'll talk to IR and have a good call with them, and I think, you know, investor relations people usually have, I think, a quota of, okay, you can use this much of the CFO's time for investor questions, and so if you've done your homework, you ask good questions, you seem like a nice person, then investor relations is probably okay giving you one of those slots, even if you're not Fidelity or
even
or
when you're a
CPP,
student,
even when you're a student, and then same thing, if you have a good conversation with the CFO, and he's got a certain quota of slots he can use the CEO on, and you might get those slots. You might get those slots too. Cool. So, like, there's a fairly big company that we're invested in, have built a pretty good relationship with investor relations, and then, you know, he reached out to us with, hey, the CEO's doing this small group call next week. You know, I can get you in if you want to be part of that sort of thing. Which, you know, we didn't get in because we're the biggest potential investor, but just, you know, built this relationship on, you know, knowing the business, long-term holders, good questions, and you get access. Cool. So that's part of it. You know, talking to customers, competitors, suppliers, like walking in stores if it's a retailer, doing all that sort of stuff too is part of the process.
Cool. I remember they like when I was in business school, they used to tell us to do that sort of thing. Like, you'd be surprised how many CEOs will like actually respond back to you. You know, it's pretty cool.
No, that's definitely been my experience.
Yeah. It's awesome for the students out there. You know, be more like John Ewing. You know?
You can be surprised.
Yeah, that's very cool. I feel like we would have been friends back in. That's awesome. Cool. So what else can you tell us about, like, you know, what are you seeing in the future of your business, and like what are you excited about going forward? You know.
Yeah, I mean, I think you've got sort of the rise of ETFs and that are really low cost, and I think for a lot of people that's a really good solution, frankly. And so I think if you're going to compete with that, like if you're going to, how do you beat Tiger Woods? It's like play him at anything other than golf. And so try and play to your strengths and the opposition's weakness. And so I think large cap stocks, like, to have an edge, to have a informational edge on 3M or Visa or Apple is really hard. To have an informational edge on a smaller cap company is it's still hard, but it's more likely, I think. And so being being like smaller cap is a good place to be. I think within fixed income, high yield is the equivalent of small cap, where it's an investment grade market is gigantic and hundreds of billions, whereas or hundreds of trillions, I think, and then whereas high yield is a little over $1 trillion, and so that's like you're more likely to find things there, and the interface between high yield and equity is something that there's a lot of, like the precision drilling example, like there's inefficiencies there. I think some of the shareholder engagement situations where you can see, if the company was doing different things, then it might be worth a different price, and being able to be your own catalyst to go from A to B is something that a lot of firms can't or won't do, and computers can't see that, and so those are ways to sort of play to our strengths, I think.
Yeah. So basically, let me see if I'm paraphrasing this right. Look after small cap and look for small cap and high yield. There's probably more opportunities there.
I think that's right. Yeah.
And then look for the deals, and then when you actually do get that deal, pick up the phone and call them and try to actually change the situation, right?
Yeah. Or at least understand the situation. And like the ideal is if you can find a company where management's doing all the things you would do if you had control. It's like, if I owned 100% of the business, then if I don't like the CEO, I can fire him and find somebody else, sort of thing. And if I own 100% of the business and I want them to pay a dividend, then they'll pay a dividend. Whereas if you own 0.1% of a public company, you can't do those things. But if they're already doing the things that you would do if you had control, then you're not at a disadvantage. And so the ideal is to find these management teams that are like great management teams and doing all the right things, and then you can just tag along for the ride, and that's the best outcome. But
that makes sense. Yeah. So you're not like an Einhorn that buys a part of a company and makes this huge public.
No, it's like it doesn't work very well. I mean, nobody likes a backseat driver, and you're trying to win on the merits of your ideas. I think tends to work better than walking around with a megaphone.
Yeah, makes sense. Definitely a unique strategy. Cool, awesome, great. So I mean, this has been a great interview. Is there anything else you want to talk about before we finish up?
Anything else I want to talk about? No, I mean, I think you mentioned a little bit like students out there, and I think it's just it's just such a fun business where you're learning all the time, and you get to like the archetype of sort of the Thomas Edison like engineer is the kid who takes apart the toaster and puts it back together and all that, and for me it's just been learning how the world works through business. That's just fascinating, and it's just a really,
business is your toaster.
Yeah. It's just really fun to.
That's cool. That's awesome.
To see the world through that lens.
Yeah, it's really cool. So I guess are you guys hiring, by the way? I mean, you mentioned earlier.
Yeah, I mean we call it the fellowship program that we sort of take entry level people, and I think they get a great 4-month experience where you get a front row seat to how the research process works, and I think we figured out ways to sort of modularize the research process that you can get. If you thought about tasks on a 2x2 grid of labor intensive, not labor intensive, and high judgment, low judgment. The things that entry level people can do really well. They've got lots of time and no judgment, and so you want to. And so if you can figure out how to delegate those kind of tasks, then I think the more seasoned professionals can be a lot more productive, and younger people get a chance to learn the process and add a lot of value and not just do busy work, which I think is what a lot of entry level roles look like. So cool. That's been a great success, and we've had probably close to 30 people through that program over time, and a lot of them have gone on to some great important roles in the industry, and it's really cool to see them go off and learn to fly.
Yeah, it's great. Yeah, that must be a really good experience, for so if you guys are, students coming in, right? That's why I brought it up. But if they're coming in, then they'll really get a chance to work with you directly.
That's right.
That sort of thing, right?
Yeah.
So you can't really beat that kind of experience, right? You get a job at, find maybe like a Goldman Sachs or something, you get the name and that sort of thing, but you're not going to be working with, the guy running the company, right? Whereas in this case,
I think small company is a great place to learn. You just get exposure to all the different things that happen.
Yeah, definitely. I know I've done that my entire career. It's definitely paid off, doing the startup thing. So,
yeah, absolutely.
Yeah, it's great.
Absolutely.
Cool, awesome. Well, John, it's been a pleasure.
It's likewise. Thanks for having me on.
Thank you very much for your time. Yeah, fantastic.